So the next part of the trading exchange UI we'll discuss is the order book. Here's our example of an order book on the right side. So an order book is just a list of all the current open buy and sell orders for a selected asset. These are all the orders that are listed on the order book, that are available, and that are activated. The list of orders is organized by price and whether or not it is a buy order, which we'll typically see in green, or a sell order, which we'll typically see in red. Typically, the buys are on the bottom, indicating lower prices. People have their buys at low, and people have their sells at higher prices on top. The top section of each section, buy or sell, is where you will find the highest bid and the lowest ask prices. Now, order books are powered by a system called a matching engine that pairs the buy orders with sell orders. This is the core of all electronic exchanges and dictates how efficiently an exchange handles a large volume of orders placed. And this is where we find the differences between the exchanges. The better exchanges, or the more popular exchanges, will typically have a better matching engine. They're able to accommodate large amounts of orders implemented at the same time, whereas maybe smaller exchanges, they might have a matching system that is suitable for their smaller exchange, for their smaller trading volume. But if a large seller or large amounts of people, large amounts of users come onto the platform, they could overload the platform. Here's some examples from a variety of exchanges. This is the Coinbase order book. This is the Binance order book, the Kraken order book, and Bitfinex. Regardless of the exchange, they pretty much all have the same function where they show our sells on top or our buys on the bottom. Typically, we'll see the lowest selling price or the lowest ask price down here, and we'll see our highest bid or our highest buy price here. And this is where the market is met. This is essentially the balance between the market, between the buyers and the sellers. They meet somewhere in the middle. Price typically equalizes at some point. So while the two sides of an order book showcase opposing information, the basic concepts needed to read them remain the same. Market size or amount refers to the total units of the selected asset looking to be traded. And then the price refers to the price point that the order is set to execute at. So here we see our market size. These are just the amounts of the coin. In this case, this is Bitcoin. So this would be, let's say there are 0.3783 Bitcoin available for sale at 33,970. Then the next would be 0.3623 Bitcoin. These are the amounts of the coin being sold or offered at those sales, at those prices. And this would be the next price, 33,980. The next chunk, we do see a large jump here at 4.8325 Bitcoin being sold at $33,990 each. And as we see, all the orders, regardless of the user, are lumped together at these price brackets. So let's say, all right, well, there's X amount of orders at 33,970. We don't necessarily know the amount of orders at each one of these prices. All we do know is that we see the amount of Bitcoin being sold at each one of these prices. And we see the same thing with the buys, right? The highest bid up here would be the highest buy price, and then as we go down, the prices tend to go lower. We do see a particularly high large buy order here, 15.6465 Bitcoin at 33,880, and this is well below the current price. So the current price, or the last traded price, was 33,966. So this person or persons, they have a noticeable accumulation of buys, of bids at this particular price of 33,880. And this is one thing we can start to take note of as we read order books. Here we see an example, the highlighted example of the order book where someone has placed a buy order for 6 0.7513 Bitcoin at a price of $33,920 per Bitcoin. Here's just another example, just to pinpoint how to read the order book. Focusing on the buy side first. So the buy side, the green section, shows all open buy orders that are below the last traded price. These buy orders are known as bids, where the buyer places a bid on X amount of units at Y price. And we'll just use those letters where X and Y are just numbers. They could be any number depending on the market. Now, when buy orders begin to accumulate in significant numbers at a specific price, we can consider that to be buy walls. Buy walls are formed. Buy walls essentially prevent the price of an asset falling, since orders below the wall can't be fulfilled until that large accumulation of orders are fulfilled, which we consider the buy wall. So here's an example of an order book. This is from Bitfinex. So in particularly, we do see, this is an older example of Bitcoin trading at $6,263. We do see a rather large accumulation starting here. Particularly, there's about 23 Bitcoin offered to be purchased at $6,269. And as price goes lower, we do see at the 6,263 price level, there are 500 Bitcoin or up per purchase. So that means there's a significant amount of people trying to purchase Bitcoin, or a significant buy order placed at this level. And we do see as we go down that there's generally a significant amount of orders at this level. Now for the sell side of the order book is in red, and that typically displays all the open sell orders that are listed above the last traded price. These prices are known as asks, or the asking price, where the seller is asking a user to buy X units of an asset at Y price. Once again, a buildup of sell orders at a specific price can result in a sell wall. This is where price is prevented from increasing past that sell wall if there is not enough buying pressure to meet that selling demand, right? There's so much people selling that it turns into a level of resistance. And the same thing with a massive buy wall, that would turn into a level of support. Price won't go below that level, or won't go above a sell wall, because there's just so many people selling at that price, and that the demand hasn't met the overall amount of people selling at that level. Here's an example of a few sell walls actually. So here we see there's a significant sell wall here at this is $9,900 Bitcoin. There's a particular sell wall at this level. We see 353 Bitcoins being ordered for sale at this level. So if price were to reach up to this level, looks like price was currently at about 9,830 was the highest bid, and the lowest sell was 9,840. So price is somewhere bouncing between those, between 9,830 and 9,840. So we could comfortably say it's somewhere around there. If price were to continue increasing, it's going to meet a significant resistance here, because there's so much Bitcoin for sale at this level. Looking forward, it does look like there is an even greater amount of Bitcoin, 908 Bitcoin being sold at $10,100. So that's even another sign of a large sell wall. And really, just this whole level, there's so much Bitcoin being sold. This is 908. This is 1,075 Bitcoin being sold at this level. So there really is a significant amount of Bitcoin being sold at this level. We can consider this a considerable sell wall in comparison to the other prices relative to where Bitcoin is. Now, traders may find it useful to analyze an order book to see buyer and sell levels at specific price points. Large numbers of buy orders at a specific price can signal a level of support in that price area. Price won't go below that very easily. Same thing with sell orders. Large amounts of sell orders at a specific price may signal a level of resistance at that price area. Price won't go above that very easily. Now, buy orders and sell orders balance each other out, where buying and selling pressure eventually equalizes and a price settles in the middle. At some point, the buyers and the sellers they equalize each other out, and price will settle at some level, right? Just as we saw before, there was significant buys and sells at 9,030 and 9,040, so price would be somewhere in the middle. An imbalance on either side could indicate that the direction of the asset's price action in the near future. So if there is an overwhelming amount of people selling, that could cause prices to go down because there's so much sell pressure and price can't go above. And if the amount of people selling continues, there's going to be almost a race to the bottom where people are just trying to undercut one another, and then the maximum price, that price ceiling, will continue to come down and push price down. Same thing as a bottom. If the buy wall accumulates at the bottom and that buying pressure increases, that could help drive prices upwards. Next thing we'll talk about is the bid-ask spread and liquidity. So bid-ask spread refers to the difference between the highest bid price and the lowest ask price. This is the gap between the buying and selling orders in an order book. So in this case here we see a gap, or a small gap, between the bids. These are our buys, and our asking price, these are our sells. So the highest bid is $2,081.25, and our asking price is $2,081.50. So there is a 25-cent spread, or 25% gap between the bids and the asks. Not necessarily a huge gap, but it does add up, and it is something to take into account. Now, market takers, people who are using market orders to buy or sell the asset, they fill this void. They're the people who come in the middle, and they will market buy at the lowest ask price, right? So if you're trying to buy, you're going to fulfill your order at this lowest ask price, and if you're trying to sell, you're going to market sell to the highest buy price. This is why it's always encouraged to really use limit orders. You want to make the market. Otherwise, you are subject to whatever the bid-ask spread is and whatever is going on in the market in the order book. Now, the bid-ask spread is also believed to be an indicator of liquidity in a market. Small spread shows signs that there are numerous buyers and sellers, and their desired prices are very close to each other. That means in this case it's a 25% spread, so that means there's a lot of buyers and a lot of sellers. There really isn't a difference, and their desired prices are close, relatively pretty close to each other's wants. A larger spread, let's say this is maybe in dollars, maybe tens of dollars or hundreds of dollars, that shows signs that there really isn't a lot of users trading that asset. There aren't a large amount of buyers or sellers meeting at an agreeable price, and that's a sign of an illiquid market. This is typically seen, we will see this a lot on altcoins, especially small cap altcoins, maybe altcoins that aren't even listed on major exchanges. If you're using some sort of decentralized exchange like Uniswap, or maybe something on like the Stellar network using the Stellar DEX, you'll find these coins that have low liquidity, and sometimes the bid-ask spread, the differences between them is very large, and it can be difficult to trade in situations like that, especially with a large amount of capital.